So a common question we get when somebody's getting ready to retire and they come in to visit us and we've done their financial plan and they know they're ready to retire, a common question they ask us is, all right, now that I'm retiring, should I take all my investments out of the stock market and put them all into bonds? And it's a pretty interesting question, and I think a misconception that people have about how their investments should change when they're approaching a life change like retirement. So when you think about your investment profile and your investment time horizons upon retirement date, you're still planning for somewhere in the neighborhood of 35 to 40 years, right? Depending on your age when you're retiring. And when you have a window like that, right, you can't necessarily think about it's time to take all my money and all my investments out of the market that have been working great for me for the last 35 to 40 years and go stuff those in my mattress and keep them safe so I can spend them. And the reason for that is that you have to take into account what inflation is going to do to time over your money, right? So if you froze your assets at wherever they are on the date you retire, eventually inflation is going to eat into your spending to such a degree that what you're going to need each year from your investment portfolio is going to grow to be such a large amount that you're going to end up depleting your assets in a very significant and quick fashion. So when you approach retirement, or when you're getting to retirement date and you're ready to go from working to not working, you really aren't making a big significant asset allocation change. You might raise a little cash so that you have the next year or two's worth of cash available for spending. But at the end of the day, you're going to keep the vast majority of your assets invested in the stock market, because the assets that are in the stock market are the assets that need to be growing to provide for you when you're 75 and 85 and 90 and 95. And you still have a portfolio of bonds that are meant to be earning some money, but also providing that level of safety so that you can endure market corrections when you're 65 and 67 and 70, right? So when you approach retirement, the actual date of retirement, don't think about your assets and your investment allocation as something that has to change dramatically. Think about it in a way of you have to continue what you've been doing so that you can be successful 35 years from now, not 3 years from now.